Welcome back. My name's Keith. I'm a financial planner here with Summit Wealth Strategies, and our focus is retirement planning. Today, we're diving into a crucial topic for anyone planning their retirement: how to grow your retirement savings. Whether you're just starting to save or looking to boost your existing nest egg and pursue a comfortable retirement. Growing your retirement savings isn't just about putting money aside. It's about making smart investment choices and leveraging various strategies to enhance your returns. Let's explore some of the key concepts and strategies to grow your retirement savings. First, let's look at the power of compound interest. This is the concept of earning interest on both your initial investment and the interest accumulated over time. The earlier you start saving, the more money you can grow exponentially. For example, investing only $10,000 with a 6% annual interest rate can grow to over $57,000 over 30 years, thanks to compounding interest. Second is diversification. This means spreading your investments across different asset classes like stocks, bonds, and real estate to manage your risk and achieve more stable returns. Stocks offer higher potential returns but come with higher risk, while bonds can provide more stability. Real estate can offer both income and appreciation. Here are some strategies to increase your retirement savings growth. 1. Contribute regularly and max out your contributions. If you can maximize your 401k and IRA contributions, which for 2024 is $23,000 to your 401k and $7,000 to your IRA, and then also an additional catch-up contribution if you're over 50. The more you can put into those accounts, the more compounding growth that you can accumulate, of course. So putting as much into your accounts as you can is just going to have more money for your retirement. 2, choose the right investment mix. Select an investment mix that aligns with your risk tolerance and time horizon. For example, a younger investor who has a longer time period before they get to retirement, they can take on more risk with higher growth potential using, stock allocations if they're comfortable with taking on that risk. But if you're closer to retirement, you may prefer to have a more moderate or conservative mix. Because when you get closer to retirement, you can't really afford to have too much volatility and too much downward movement with your portfolio because you have less time for recovery. So when you're younger, you can be more aggressive. When you're getting closer to retirement, you want to move towards more of a moderate conservative mix. 3, stay informed and adjust your strategy. Regularly review and adjust your investment strategy based on market trends and personal circumstances. Rebalancing your portfolio can help you maintain your desired allocation. So, for example, if you have a portfolio of stocks and bonds and you're trying to stick with a 60% stock, 40% bond allocation, and the market grows significantly, your stocks could eventually become 70%. So rebalancing is moving some of your stocks over to bonds or the other way around to maintain that 60-40 allocation. And maintaining that allocation is going to be one of the most important factors to getting your long-term results. 4, minimize fees and taxes. If you choose low-cost investment options, your less fees means more return for you, right? Less cost is less money that you have to give to somebody else. So low cost is really important, but also tax efficiency. And you can use tax advantaged accounts like a 401k or an IRA to put money into the account before taxes, and you get tax deferred growth. And when you withdraw that money in retirement, it's going to be taxed as ordinary income. There's also Roth IRA accounts where you put the money in after tax. So the money's already been taxed when it goes in, but now all the growth is tax deferred and tax free in retirement. So using a tax advantage account allows you to have compounding interest where you're not having to give taxes every single year on your growth. and you can let that money stay in the account and accumulate and compound. For accounts that are not in retirement accounts, non-retirement money, you can use strategies like tax loss harvesting to reduce your tax impact for that account. And what tax loss harvesting is let's say you have a mix of stocks and one of those stocks is at a temporary loss. You can sell that stock at a loss and reinvest it elsewhere into, let's say, the S&P 500 or some other position, and you capture that loss and it'll offset gains. 5, consider professional guidance. Financial advisors can provide personalized advice and help you navigate complex investment decisions. Their expertise can help you pursue your retirement savings growth. So you don't have to face this alone. You don't have to be all by yourself trying to navigate this and hopefully you get it right. You can find a professional person, an advisor who can come alongside you and really help navigate all these decisions and put together a comprehensive strategy. Now let's look at some advanced strategies. First, we have Roth conversions. Converting a traditional IRA to a Roth IRA allows you to move money from an account where you would be taxed on all of the income from the IRA. If you move it to the Roth IRA through a Roth conversion, you have to pay taxes when you do that on the money that you move. But now that it's in the Roth IRA, it can grow and accumulate in a tax-free environment where now all the withdrawals in retirement are going to be tax-free. There's also no required minimum distributions on Roth IRAs. So if you don't need that money, you don't have to take it out like you would in a traditional IRA where you have to take minimum distributions later in retirement. Second, we have real estate investments. Real estate can provide both income and appreciation, and you can own real estate directly. You can own real estate through REITs. You can also own real estate in other ways, but really real estate can provide both some income and appreciation, and it's a very interesting asset to have. Next, we have annuities. Annuities come in all shapes and sizes. There's fixed annuities, there's variable annuities, there's index annuities, there's many different purposes, and annuities are real specialized vehicles that can provide unique benefits like guaranteed income for your whole life. There's annuities that can provide protection against market-based risk. There's annuities that provide fixed returns like a CD would. So annuities can be a very powerful tool. The idea is that you want to use that tool for a very specific purpose, and it can be a very helpful tool within the mix of investments that you have for your strategy. Next, let's look at some real-life examples. The first example is Jane. She's an early saver. She starts contributing with $500 a month to her 401k when she's 35, and by age 60, her disciplined savings and compound interest have significantly grown her retirement. So if you can just consistently add money to your retirement every single month for a really long time, that plus the compounding growth, you can actually make a little bit of monthly amount into a large sum of money over a long period of time. So that consistency can be really powerful. The second example is John. John being 50 years old, he's maximizing his contributions, putting as much into his accounts as he can. And he's also seeking professional advice by an advisor. So by the time he's 65, if he can put as much as he can away and do the very best with the investments as possible, he's putting himself in a position to be prepared for retirement the best that he possibly can. Next would be the real estate investor. So Susan, if she's 45 years old, she's diversified in her portfolio with rental properties and REITs. The real estate investor can enjoy that property appreciation as well as a robust, income from her real estate in retirement. So finally, let's avoid some common mistakes. First, we've got delayed savings. If you wait and you don't put anything in your investments for a really long time, you're just missing out on that potential compounding growth. So the earlier you can start, the better. Delaying your savings can really impact the size of your nest egg later on. Second, ignoring inflation. Inflation erodes our purchasing power. It makes the dollar worth less. So a cheeseburger at McDonald's used to cost $1, and now it's $5. In the future, it's going to be $20. So investing in assets that can outpace inflation, where you can get a larger return than inflation is eroding our purchasing power, can help you stay ahead of inflation. So the third is similar in that if you're too conservative, then you're not getting enough growth to keep pace with inflation. So we need to protect the capital. That's important. But if you're too conservative with growth, you're also losing. So we need to have at least some growth to keep up with purchasing power and your income needs and your goals. So let's make sure to be protecting of principal, but also achieving enough growth. So thanks so much for watching. If you found this video helpful, please like and subscribe to our channel. For more detailed insights, check out our blog posts listed below and visit our website for more resources and to schedule a consultation with one of our specialists. See you next time.